People can join. Perfect, it's automatically recording. Okay, there's only one participant right now, and I think that's me. Okay. So I'll put in the chat, that way people can see. Hi, everyone. Oh, this isn't on. Hello, everyone. Welcome. There we go. And I can turn this off if it's too loud when you're doing your part. But welcome everyone to our February Old National Bank series. We are very excited to be joined by Latoya today, who's going to talk to us about personal finance, investing, and retirement. Nate is in the back. Hello, Nate. Nate is going to take all of our kiddos in the room up to carousel. So please find him, and you guys are going to have such a good time. And if you have questions throughout the presentation, just raise your hand and we can address those as we go. And for those who are watching virtually, please put your questions in the chat and then I will ask them for you as we go. But we're also going to have time at the end for questions if you'd rather wait. So I will turn it over to Latoya from Old National Bank, who is going to go through this with us. So thank you for joining us.
Yeah, let me, if you want to turn the mic off, it's right on the top, so it's your preference.
Yeah.
And can I take the clicker?
Oh, yes,
Thank
absolutely.
Should have tested
It
it.
should be on, but I don't have it pulled up quite yet. So let me, did you want to introduce yourself or do you want me to pull the?
Yeah, you pull it up.
I'll pull it up.
Thank you.
No problem. Oh, I have to screen share first. Share screen. Share. Okay. There we go. Oh.
There we go.
There we go.
Yay, let me make sure the.
I mean, I can always move it if it's not.
Okay, yeah. Oh, there we go.
Oh, okay. Maybe.
Maybe.
It's me.
Or maybe that was you.
I think that was.
Okay.
me. But
All
either
right,
way.
I'll just say next. We'll go next. All right, we'll go back to the first one. Sorry about that,
No, no
guys.
problem.
Well, thank you, Kelsey, for the warm welcome, and definitely welcome to each of you to the Investing in Personal Finance session with Old National Bank. My name is Latoya Williams. I'm National Bank. I've been in the financial services industry for 17 years. So I'm really excited to share with you and we'll give just, it's okay.
But I realize that I can't see the chat when we're screen
When we're
sharing.
screen sharing.
So I am just gonna put a little note.
You want me to turn the mic on? Okay. We're gonna, is that better? Better?
There it is.
Okay.
Questions will be taken at the end in the chat during screen sharing. Please. Here. Great. I just realized that I wouldn't be able to see if someone asked a question. So we'll leave that there for now.
Okay.
And we will start our slideshow.
All right. All right. Again, welcome. Definitely excited to talk to you guys about investing in personal financial planning. The topics that we're going to cover tonight are why people invest, investment risk, preparing for investing, common investment vehicles. We'll also talk about investment basics and the stock market. And we will conclude by talking about why and how you need to review your plan, as well as creating the next exit strategy. So we've got a lot to cover. And as Kelsey said, if you do have any questions, feel free just to stop me, raise your hand. I'm happy to answer any questions that you guys have at any time. Okay. Next slide. Now, I didn't know that I was going to be surrounded with a room full of women. So you guys may know this person and you may not. Does anybody happen to know who this is? Okay, Tom Brady, that's exactly right. And I share this slide because, you know, I think of what Tom Brady does as a quarterback, similar to what I do in the financial arena. You know, not that I have reached GOAT-like status like Tom Brady, but everything that I do in my work is about teamwork. I love being a part of a team. You know, I know that there are things that I can do really well, but there are things that I cannot do at all. But when we partner, when you bring your best and I bring my best and we put that together, we can win together. And I love that magic. I love being a part of a team. When I'm working with my clients, again, I consider myself a quarterback. I want to understand my clients' financial goals, and I want to be able to connect them to the right resource to ensure that whatever their goals are, I can help provide the resources that they need to meet those goals. Now, the GOAT just recently announced his retirement. You guys probably heard that. But if you caught the last game that they played against the Rams, it was quite the phenomenal game. At the half, the Buccaneers were down 27-3. They had 3 points in the half. And so I'm watching this game thinking there's no way Tom Brady and the team can possibly come back. But what he rallied his team to do in that second half, again, completely phenomenal. Now, they didn't win, but they ended up losing by just 3 points to close the game out to a score of 30-27. And the reason that I think that that's important, again, it's the team. The team came together. And the reason I think that's applicable to us is no matter where you are in your financial planning, whether you're, just getting out of school and, getting your first job, or if you're in your mid 40s and you're thinking about, what do I need to start doing from a financial standpoint to secure an appropriate future for myself and for my family, with the right team, any goal can be accomplished. So what I want to make sure that we understand tonight is surrounding yourself with the right financial team can certainly help you reach any goal that you have for yourself and for your family. Now, I'll add a caveat. Old National Bank does not endorse Tom Brady, the Buccaneers, Tampa Bay Buccaneers, or the NFL. I had to add that in. Okay, we'll go to the next slide. So why do people invest? We can go ahead and go on to the next slide. People invest for many reasons. The first reason is your vision. We know everyone has a vision for the future. Everybody's vision is different. What I want to do when I retire, I'm sure it looks different from what you all want to do. But one thing that we know for certain is that we're all going to need time, and we're all going to need money to do those things that we're envisioning for ourselves and for our family. Another thing that we also know is that investors or retirees of the past didn't have to necessarily know as much about investing as we will need to know to secure our financial future today. So we really want to start getting ourselves educated around the investment world and how it can provide lucrative resources for us when we reach our retirement age or whatever goal that we set for ourselves. And the big reason is we want our money working for us while we're asleep. That sounds pretty good, right? Getting some return and things working for us while we're laying down in our bed. But again, the right financial plan is really going to start with you knowing what financial security means to you. And again, for everybody, it's different. But start thinking about that tonight as we're having our conversation. What's important to you from a financial standpoint, and what goals would you like to accomplish for your family? There may be things like you have loved ones that you're going to need to take care of in the future. Or maybe you're someone that has had concerns and worries about money, and you want to feel a bit more secure, worry-free, and independent. Maybe you're someone that desires to be philanthropic and donate time and money to organizations. Or if you're like me, I'll admit my guilty pleasure. I want to have fun. I want to buy some big toys and do some great travel when I reach my desired retirement age. So it doesn't matter what your goal is. We want to create that plan customized to whatever you're visioning for yourself and for your family. Now, before we jump into the benefits of investing, let's talk about the risk, because there are risks associated with investing. And unlike, I'm sure you guys have all seen some of those pharmaceutical commercials where they tell you all the benefits first and you hear the risks later, I'm going to tell you some of those risks that are associated with investing up front, and why you need to consider that as well. There are three things that we want to think about: is how comfortable are you with your account, the accounts that you have dropping during a particular time. Let's say you had $100,000 in an account, and tomorrow that account drops by 30%. Are you going to be comfortable with that? You need to know what your risk level is and how comfortable you are with fluctuation. We also want to keep in mind that there are varying risk levels associated with different types of investment vehicles. And we're going to walk through that in detail to show you what those vehicles look like and how risk can be associated with those various vehicles. But we also want to keep in mind that we need to measure our risk against potential reward. This will make a little bit more sense as we continue. We want to think about, again, I mentioned any investment could have the potential to lose money. So we want to make a plan for if something doesn't go right. We could lose money. You could also, when you're investing, miss out on an opportunity, meaning that your money is locked up in one investment and you can't take those dollars and put it into another investment. So these are some of the risks that we want to start to think about. We also want to keep in mind that lower returns typically equals lower risk. Whereas higher returns, if I'm going to get a big bang for my buck, that's going to typically shoulder much more risk. So we really need to understand that before we create our plan. This slide essentially demonstrates how risk is associated to varying investment vehicles. The first investment category that you're looking at are going to be things that are considered more cash equivalent, things like money market funds or CDs. Things that carry lower risk aren't going to have a high return. But investments like international stocks or speculative investments, again, may have a greater return. But again, we're shouldering more risk. So we need to have an appropriate balance of that risk mix when we're making our investment selections. Again, risk is going to be different for every person. We really want to have a solid understanding about your comfort level. We also want to think about, what is your time horizon? For some of you, you've got 40 years before you're going to reach your desired retirement goal. For others, you may be not thinking about retirement. Maybe you're thinking about making a big purchase or sending a child to college, and you want to invest those dollars for a shorter duration of time. Again, everybody's situation is different, so we really want to get specific about what your plan is and what you want to accomplish. We also want to think about is we really don't want to invest money that we can't afford to lose, because that's certainly going to keep us up at night if we've got money in an investment account and that those dollars are fluctuating and we can't afford to lose that money. So we want to keep that into consideration. Now, what we're looking at here are a wide variety of risks. I'm going to save inflation, and we're not going to talk about that one right now, but the ones that we will hit are the remaining investment risks. So liquidity risk. Liquidity simply means that I can't liquidate or sell my investment in order to make another investment in a reasonable amount of time. So liquidity means cash, that we can get cash into an investment vehicle. That's a liquidity risk. We also have interest rate risk. And now this is a topic that we're dealing with right now. If you're listening to the news or paying attention to anything that's going on in the news, rates can potentially rise. And while that is good for the bond market, there's risk that interest rate rising has a negative correlation to the stock market. So today, the announcement was that rate returns could potentially be rising. So that takes the stock market down and depresses potential returns in the stock market. Interest rates and the stock market, they have an inverse relationship. I like to think of it like a teeter-totter. If stock prices are high, like we've seen for the last several months, the interest rate market is going to be low. And when that flips, the teeter-totter is going to switch and the stock market prices are going to go down while interest rate prices are a little bit higher. There's business risk. So let's say you're someone that wants to purchase an investment in a particular business and bad press comes out about this business. That could affect the value of your investment inside of that particular vehicle. We also have credit risk. The credit of the organization could also affect the investment dollars that you've placed inside a particular vehicle. And we have opportunity risk, which we just talked about a few moments ago. And essentially, it means that I can't get into an investment in the appropriate time while the price is right. And I also can't get out of it in the appropriate time that I'd like to get out. So that's opportunity risk. We have market risk, where the markets are fluctuating. Right now is a prime time for that. If you think back probably to about 2008, that's when we had the last big market correction. And that's a risk specifically for someone that's nearing or in retirement. If you haven't looked at your accounts in a while and your accounts are too heavily leveraged in one type of investment, you could potentially be working for a couple extra years to recoup some of those dollars that you've invested. And reinvestment risk. What is reinvestment risk? Essentially, what reinvestment risk means is that I'm not taking the money that I've gained and putting it back into an investment to get some return on those dollars as well. And lastly, political risk. Anything that's going on in whether it's our country's political system or another country's political system can potentially have a negative impact on what our returns look like. So those are the large majority of the risks that you can experience. But I want to talk about inflation because you guys are probably experiencing this just like me. Every single time I go to the grocery store, my groceries in my cart are getting smaller and smaller. And that's because of inflation. There was a broadcast on NPR while I was driving over. And what I heard was that for the month of January, the inflation rate was right around 7.5%. So that means our dollars are buying 7.5% less than what they were buying in December. So inflation is an extremely important risk to understand, but unlike the other risks, it's a risk because if I'm not invested, I'm not getting any return. My dollar is just losing purchasing power gradually. And what sticks out to me on this slide the most is that 1960s. Look at that 1960s. This is what you could buy for $1. A movie ticket, a bucket of popcorn, and a candy bar. I don't think you can get out of the movies today without spending $40 for a couple. And that might be low. That might be low. So it's very important to really understand these risks and how they affect you. We can go to that next slide. And essentially what this describes is, again, inflation affects our purchasing power. We want to ensure that whatever goal that we're setting for ourselves, we understand all of the risks that are associated with the investments that we make. But again, inflation is really one of the ones that we want to focus on the most, because if we're not invested, if we don't have dollars in some type of investment vehicle that are working for us, essentially we'll find ourselves, some years removed, like the person in 1960 thinking that that dollar is going to get us a good day, and it's not. So we really want to take time to get educated and make sure that we're investing those dollars for the future. So we've talked about risk. I put the bad stuff out there first, right? So let's talk about the good stuff. Let's talk about preparing for those investments and how we can utilize investment vehicles to secure, again, whatever visions and dreams that you have for yourself and for your family. Some of these are a bit redundant, so that's okay. Some of these are a bit redundant, and when I see that, I'll just skip to the next ones. But things that we want to think of prior to making that plan is we want to make sure that we are clear on what our vision is. We want to make sure, again, that we are getting a trusted mentor. So a lot of times people are making decisions from a financial standpoint, and they haven't necessarily consulted someone that can provide them sound advice. We also want to make sure that we're not making decisions solely based on emotion. So I mentioned earlier in regards to risk, if we woke up and we saw that our account was down by 20 or 30%, what decision are we going to make? Are we immediately going to want to make a decision to sell? Or can we look at the account and understand that, we've got a plan and the plan is down the road and we don't have to make a decision today. So not making emotional decisions are things that we want to think of. We want to make sure, again, that we have confidence in the decisions that we're making, and again, not taking advice from the wrong representatives. So some of the biggest plans that you'll see, and ones that you guys are probably most familiar with, the most common vehicles, are going to be personal retirement accounts. And there are two separate types of personal retirement accounts that you all are probably familiar with. The first is a Roth IRA, and the second is traditional IRAs. Are you guys familiar with those types of accounts? Somewhat? Okay. So we'll just walk through the differences between those two accounts. Go to the next slide. The Roth IRA is an investment vehicle that gives you the ability to invest your dollars with a tax benefit of not having to pay taxes when we begin to draw dollars out. So I'm going to think about, again, saving for retirement. I have the ability to take money that I've paid taxes on today. I'm going to put that money inside of a Roth IRA. That money that I put in the Roth IRA, we'll talk about some investment vehicles a little bit more specifically, but we're going to exceed that 3% inflation rate, right? We want to gain money on that account. When we start to take distributions or draw dollars down from that account, once we reach our retirement age, which is 59 and a half, and we've kept those dollars in that plan for 5 years, there will not be a tax liability on those dollars. And so this is an account that if you are starting your career, or if you are in a lower tax bracket now, this is an account that you probably want to take advantage of. Again, you're locking in your tax rate. You're investing dollars, we're getting a return, and then at retirement, when I start to pull those dollars down, I will never have to pay taxes on the profit. So it's a really nice deal. And for those of you that have kids, maybe that are graduating and getting their first job, they're 18 years old, they're probably making the least amount of money that they're ever going to make in their life, but they're also probably in the lowest tax bracket that they're ever going to be for the rest of their life. Roth IRA would probably be a great vehicle for them to consider starting to make some contributions in for their future. And when I was 18 and 19 years old, if somebody would have told me that, I might not be here tonight. But no, it's a great vehicle. It's a great vehicle when you get started investing those dollars early, they can secure a strong financial future for themselves. The other type of account that you have the availability to invest in on an individual side is a traditional IRA. Now, a traditional IRA works similar to a Roth account. The difference is you're going to pay, you get a tax benefit today. So you're going to make those contributions in with pre-tax dollars. Now, there are a couple of caveats with this account. When you set these accounts up, you're probably going to be working with your local bank or another trusted advisor to establish these accounts. With a traditional IRA, while it is touted as something that is pre-tax, you're probably taking money from your paycheck and putting those dollars into that account. So it doesn't really sound like pre-tax, right? I mean, because you're taking your after-tax money and putting them in. The benefit here is when you file your income taxes, you're going to get a form from the company that you've chose to create this account with, and you will get a tax credit for making those contributions into a traditional IRA. Now, because you get that benefit and those dollars are looked at as pre-tax dollars, when you reach retirement, again, 59 and a half or older, and you start to draw those dollars down, you will pay taxes based on your ordinary income. So whatever your income level is, you'll pay taxes on the money that you draw down based on that income level. So those are the differences between traditional IRAs and a Roth IRA. You're probably also familiar with employer-sponsored plans. Do these counts sound more familiar? 401k, 403b, those are probably more familiar to most of us. Go to the next slide. One thing that we want to think about, and I'm going to talk about those 401ks and 403bs in a moment, but one thing that we do want to keep in mind, again, with the traditional IRA and the Roth IRA is that there is a mandatory withdrawal at a certain period of time. And our slides are a bit outdated. The Secure Act did get passed a couple of years ago, and it increased when we have to take distributions down. And that's at age 72 now, as opposed to 70 and a half. But trust me, your financial organizations won't let you forget it. They'll send out a notification to you, letting you know when you need to start taking those dollars down. But these are just really two great vehicles, additional ways for you to think about saving for retirement that you might want to take into consideration. From a tax standpoint, I would recommend whoever you work with for your taxes to have that conversation. Ask them to help you determine, which vehicle is most beneficial for you, or you can also talk to your local bank and they can help point you in the right direction as well. So the next accounts that we're going to talk about again are those more familiar accounts, those employer-sponsored plans. Employer-sponsored plans are known as defined benefit or defined contribution plans. Defined contribution plans, again, you're probably familiar with 401ks or 403bs. Everybody pretty familiar with 401k and 403bs. These accounts give you the benefit of making contributions in on a pre-tax and sometimes a post-tax basis. So 401ks can combine that Roth and that traditional IRA feature that I talked to you guys about a bit earlier. So some 401k companies or some companies, they want to give their employers a variety of ways to save for retirement. But the thing that you want to keep in mind with these accounts is that you are making those investment selections and you are selecting how much you're going to contribute into your retirement account. And if you have a plan, I've been doing this, I've been in the industry, like I said, for 17 years. And I used to sit down with individuals that were in retirement accounts. And sometimes they would say that they didn't want to make contributions in because their employer wasn't matching them. And I always told them, Well, just because your employer isn't matching you, you might still want to consider making those contributions in, because Social Security, it might not pay what you think that it's going to pay. And for most people retiring today, Social Security is only going to represent about 40% of their income. For us and for our children, whether it's there, we don't know. I think the year was 2030, 35 or 39. I'm not sure exactly what the year is when that system will be depleted. But if you have the benefit of this type of account, whatever you can afford to contribute, please consider making those contributions into your retirement accounts. That's okay. You make your investment selections. The thing to keep in mind with this is your payout at retirement isn't something that's guaranteed. You're building a pot of income that you at retirement will determine how much you begin to draw down once you reach your desired retirement age. And again, that's another reason why it's important to think about having a team, so that we can help you define what that income level would be that's going to allow these accounts to last the duration of your retirement years. For most people nowadays, that retirement period can be just as long as their working years. You know, there are retirees that are retiring at 65 and they're spending 30 years in retirement. So again, if you have these types of accounts, certainly consider taking advantage of them. And if you do have an employer-sponsored plan that you're contributing to now, or that you've contributed to in the past through a previous employer, one thing or piece of homework that I would highly recommend that you take advantage of making sure is that you have a beneficiary designated. Again, in the years that I've been doing this, this is the one area that goes completely overlooked. Either the wrong beneficiary is designated, or there's no beneficiary designated at all. Now, if there's no beneficiary designated and you're married, naturally those assets are going to go to your spouse. But those dollars are going to have to go through probate, and the state of Indiana is going to get involved, and they're going to help disperse the dollars that you've saved. Now, in the event that the wrong beneficiary is listed, can anybody imagine what happens when the wrong beneficiary is listed? The wrong person is inheriting your money. And I actually have seen this more times than I can count. I've taken phone calls from people because the wrong person was listed, but I actually had a personal encounter with this just a few months ago. I had a friend who she worked till she was 70 years old and she retired. And before she retired, in the late 80s, she was dating someone that she didn't want to get married to, but they were dating and they decided to live together. Her request was that he put her name on the deed of his home. He made that request. He put her name on the deed of his home. They did not get married and the relationship dissolved. A few months ago, actually late spring 2021, she got a notification that she was an owner of a home because he passed away and never updated anything, never updated his deed. And so there was nothing that he could do. My friend is now the inheritor of a home because the gentleman didn't take the time to do his due diligence, making sure that the right people or the right persons were listed as beneficiary. So homework, if you have any type of accounts, whether it's a checking account, savings account, whatever types of accounts you have, do your due diligence and make sure that the right beneficiaries are listed. You might have listed your children as beneficiaries. If they are underage, if they are 18 or younger, they will not be able to inherit those dollars. Those dollars will go into, typically is going to go into probate until a guardian is assigned for them. So the best way to protect yourself and to protect your family is to have a trusted loved one, someone that you trust and someone that you know is going to distribute those dollars to your children at the appropriate age. Don't just list your children because it's going to delay getting those dollars in their hand. Okay. The second type of account that you're going to see, and again, the slide is wrong with taking those distributions at 70 and a half. It is now 72. The other type of account that you all may have or may have seen are defined benefit plans or pension accounts. Anybody familiar with those pension accounts? Yep, they're what we consider dinosaurs. Most companies are not offering them anymore because they're very expensive to maintain. Pension plans are where companies take those dollars for you, and they're putting that money in the account for you. You don't have to make any contribution. And when you retire, you have a stated benefit or a guaranteed benefit for the duration of your lifetime. And as you can see, that just isn't sustainable for a lot of corporations to offer nowadays. So if you have one, or if you've worked at an employer in the past and you're not sure, I would recommend reaching out to your prior HR teams and just finding out. You never know. There are lots of people that have these type of accounts. They've worked for employers in the past and they weren't aware that these benefits were available to them. Those are the primary two type of retirement accounts that you'll see. Now with 401k accounts, sometimes you have the ability to purchase publicly traded stock. And so, for example, with Old National is a publicly traded company. So inside of our employer-sponsored plan, you can purchase your company's stock inside of that plan. That's typically the only type of investment, a single stock that you can purchase. The majority of what you're going to be able to purchase are mutual funds. And we'll get into the specifics of those types of investments shortly, but those are just a couple of things to keep in mind. Early withdrawals, anytime you take money out of those accounts early, premature to retirement age, and again, that's 59 and a half, you may be subject to early withdrawal penalties and deductions. So you do want to keep that in mind. Right now, that's a 10% penalty on top of your ordinary income. So if your ordinary income taxes is 25% and you took out of your 401k or your retirement plan before you reach your desired retirement age, that's now we're paying 35% on the money that we've taken out. And remember, inflation is going up. So we're really shooting ourselves in the foot when we take those dollars out prematurely. Okay. The things that we want to think about, again, the benefits of those defined contribution plans is that we're going to be placing those dollars in. We're going to be getting some return on our investments that we've selected, but keep in mind again that those benefits are not guaranteed. And remember to look up your accounts and make sure that we've got the correct beneficiary listed. With defined benefit plans, one thing that I'll highlight here, if you do have one, it has a built-in feature to be inflation adjusted. So that inflation that we were talking about earlier, if you do have one of these plans, that's a benefit for you that most pension plans offer, is that you're not going to have to be worried about inflation as much if you do have one of those plans. And again, the investment selections are automatically made for you. All right, so we know the risk that we are going to face if we select, if we're getting invested in the market. We understand the most common types of accounts that are available that most people are taking advantage of. So now we want to think about is how do we actually think about making investments? What type of investment am I going to select now that I have this account? Let's jump into that a little bit more. So again, there's always going to be risk and there's always going to be potential reward. The three things that we want to think about when we're investing is leverage, liquidity, and diversification. With leverage, essentially what that means is you can take a small quantity of money and have control or purchasing power in a big corporation. So think Apple. You know, if you wanted to buy a piece of Apple, you can take $500, you can invest in Apple, and now you have control of that specific company. And as Apple performs well, which it looks like when I came in, almost everyone had some form of Apple product, right? So we think they're probably doing pretty well, and they are. You get to take advantage of the growth of that company. So that's leverage. That's giving you a piece of control of that large corporation. Liquidity, being able to turn your investment into cash quickly. We want to make sure and understand the investments that we have. Do they give us the ability to liquidate them and get cash in hand for the investment selections that we've made? And diversification. Diversification essentially means, you guys are going to see in a moment, there are a wide variety of investment options. There are a lot of people that will take their dollars and invest in one asset class. Again, I just mentioned Apple. Well, if I take all of my money and put all of my money in Apple, and then everybody suddenly stops buying iPhones, am I in a very favorable position? Probably not, because what that means is the price of Apple is going to go down. And again, we know that the markets are going to fluctuate, right? We talked about those risks that can be associated with the various investments that we have. Diversification spreads that risk. I've got some Apple, I've got some Nike, I have various investments in my portfolio. And so now I don't have as much risk as if I just had one investment category. So when we're thinking about investing, again, that plan comes back up. When we're thinking about investing, we want to, again, what is our time horizon? Is this specifically for retirement? Is it for education? We want to know that. And again, thinking about investments where we have a longer duration of time, if I've got 40 years, I can afford to be a little bit more risky with those dollars that I'm placing into the market. So this is a demonstration of the various types of investment vehicles. So the first thing that we're looking at is savings accounts and CDs. And if you remember back to that graph of risk and reward, those savings accounts and CDs are going to be more on that, that safe side where they carry less risk. We have annuities. An annuity is a vehicle that gives us the ability to take a portion of money, a chunk of money, and buy guaranteed income for ourselves for a specific period of time. So let's say that I'm someone that I'm preparing to retire, and I know that I'm going to get, I know that I need $3,000 to cover my bills. And from Social Security, maybe I'm going to get $2,000, but the money that I can draw down from my retirement plan isn't going to get me all the way exactly where I need to be to cover all the bills that I have. Individuals can use an annuity product and get that guaranteed income. So essentially what annuity gives you the ability to do is create that pension that we just talked about. Again, you can speak with an investment professional and they can walk you through those details of what that looks like. But there are two different types of annuities. There is an annuity that is a fixed annuity. It's going to be closely tied to the CDs and things that are more cash equivalent, and it's going to have a stated rate of return, which is typically going to be very low because it's fixed. Then we have what's called variable annuities. Variable annuities are going to be tied to the stock market. And if it's tied to the stock market, what we learned is it's going to be up and down. So there's potential for risk on that variable annuity. But again, it's a way for you to create guaranteed income for yourselves. We're going to walk in more detail into stocks, mutual funds, and bonds in a moment. Real estate is another great investment. I heard on NPR yesterday that in some cities for real estate investors, rents are up as much as 40%. So for people that can invest in real estate, they can. It's a really great investment right now. So real estate is one type of investment, but you can also buy real estate vehicles inside of your retirement accounts. So you might not be able to go out and buy, a apartment building, but there could be a mutual fund that has a real estate company inside of it, and you're owning a piece of that real estate inside of your retirement plan. Again, which is why it's important to have a trusted advisor and really get educated around all the ways you could buy into some of these things that we might not ordinarily be able to do just with walking up, with cash on hand. So there are a variety of ways that we can get real estate into our portfolios as well. Commodities are going to be more things like oil and gas or wheat. And Forex, private equities, hedge funds, and cryptocurrency are completely out of my purview. I focus primarily on retirement accounts, but if you are interested in things like that, there are tons of courses that you can enroll in and get more education on some of those more speculative investment vehicles.
Yes, okay, excellent.
Sorry.
Just need to do a time check at 6:45. Okay, but we can totally continue. Perfect. Okay. So how the stock market works. So we'll talk about how that works. Essentially, again, I talked about Apple. So when Apple decided to become a publicly traded company, there were a few things that they were thinking. They want to raise capital. They want to potentially open new locations, or they want to expand to an international location. The benefit to me buying Apple is I get to take advantage of their price going up. So as the price of Apple goes up, I'm making more money, right? The dollars that I invested are going up.
There also the ability for some stock investments to pay a quarterly dividend. Now, every stock doesn't pay a dividend, but there are a large quantity that do. And essentially what a dividend is, it's because you invested in this company, you're going to get a little extra. You're going to get a little extra payout from us on a quarterly basis. So those are a couple of different ways that are beneficial to us when we place money inside of the various investments that we have. But again, as I keep saying, there's always that risk and nothing is guaranteed. So when companies go out to raise capital, you can go to the next slide. Essentially what they're doing something called an initial public offering or an IPO. And when I started in the industry, one of the things that I had the ability to do was sit on what we call the syndicate desk. And the syndicate desk is where we bring new issues to market. And one of the first stock issues that I was working on was Visa. So Visa wasn't always Visa. When Visa became publicly traded, what they do is they go to brokerage houses, and what the brokerage houses do is they farm that out to other advisors across the country. And they say, ask your clients if they would be interested. It's probably not this simple, but I'm assuming this is how the conversation goes. Ask your investors if they're interested in the product that we're going to sell. And so that was my job. I had to take indications of interest from our clients. We sent that indication of interest back up to the investment company, and go to the next slide. And based on what the indication of interest was, that's how the stock got priced. So we are getting what's the demand and what's the supply. We're taking the demand and how many people are interested in this particular investment. So when Visa IPO'd back in 2008, and when they first became a publicly traded stock, they hit the market at $40 a share. Today, or yesterday, Visa closed at around $220 a share. So if I was someone in 2008 that invested $40, let's say I bought 100 shares, $4,000, right? Today, that $4,000 would be worth roughly $22,000. So that kind of gives you an idea of the benefit of long-term investing and understanding kind of how those prices can fluctuate. Now, certainly there were some days when it wasn't at that $200, $220 rate of share. But if you stay the course and stay with it, typically what you're going to see is those investments are going to be able to pay out for you nicely. There it goes. There are also two different types of market sentiments. There's what we call a bull market and what we call a bear market. A bull market is when the stock market is rising. It's going up and up and up. And that's a great time, right? Everybody is making a lot of money. Everyone is happy to be invested. But things are also pretty pricey during a bull market. So if I'm someone that is trying to get in, I might not put all of my money into the market during a bull market. Why? Because I'm going to be paying more. Kind of like the real estate market today. If I'm looking for a house today, my goodness, you're going to pay an arm and a leg for what you could have got for thousands of dollars less just a few years ago. A bear market is just the opposite. A bear market means that prices are going down. Now, most people don't like a bear market. I see a bear market as a buying opportunity. And I can't predict when we're going to be in a bear market, although based on the inflation rates that we're seeing, the probability is that we could go that way very soon. And if so, if you aren't investing your dollars in the stock market, if you haven't had those conversations about how to invest those 401k dollars, now might be the time to think about that as we see those prices dip, because you can buy some really great companies at a discounted rate. Okay. All right. So now we want to think about we understand the various vehicles, we understand the various markets, we know about our risk, and now we want to actually get into the market. Again, the first thing that we want to think about is, what is our goal? Are we looking for capital appreciation? Do we want these dollars to grow, or do we need income? So we want to be able to determine which seat we're sitting in. Do we need growth right now, or do we need income? We also want to think about, is that a short duration goal, or do we have a long duration goal? Because it's going to make a difference between how we select the investments that we opt to invest in. And we want to think about the management style. There are two separate management styles, which you'll typically find with those retirement accounts that you have. You can have active management, meaning that someone is making investment selections at all times. They're trying to time the market. And there's passive investment, meaning that the investment is just going to mirror whatever the stock market is doing. And if there's fluctuation, no one's going to be looking to change those investments. So you want to determine which one of those options are going to be most beneficial for you. And we kind of went through those details. Sorry, you can go to the next one. Can skip that one. So we want to think about, and I kind of walk through what active and passive management looks like. If you have a retirement plan, I would recommend that you request your plan document summary from your company, and you'll be able to determine very quickly whether or not you have access to active or passive investments. And for most of your plans, what you also have access to is a financial expert that you can ask questions to. I know this is a lot of information, and if you guys have any questions around this, again, I certainly would love to take time and answer any questions that you have. I think we're probably about at our time.
We have about like between 5 and 10 minutes at this point for
Okay.
questions. So I
Okay.
don't know if you want to. Did you want to ask?
Yeah,
something
let's
else?
pause and determine are there any questions that you guys have. I know that's a lot of information, but I'd be happy to answer any questions around investing or anything that we've covered. Yes.
My question is, earlier you said that you can designate beneficiaries for checking account as well. I didn't realize that.
Yeah, you typically, most organizations or most places are going to give you the ability to designate a beneficiary, because if in the event that something happens to you, those dollars have to go, they have to go somewhere.
Okay.
Yeah.
Need to, I guess, go back, make sure that's set.
Yeah,
Go back to my
definitely.
institution.
Definitely. I mean, and think of every type of account that you have, anything that you have, from even updating life insurance, that sometimes when that's selected, either through an employer or through purchasing a separate product, again, once it's set, or once you're no longer here, it's set in stone. And there are some times where families do contest the beneficiary that's been placed, but typically it doesn't get overturned. So yes.
You can also do the trust,
Yes.
whatever you have, be it properties, retirement, insurances. If you have kids and you want to go a certain way for them, it'll go the way you say, and no matter what anybody says.
Yeah.
For properties and
Yes. Yeah. And in the situation that I described with my friend, had that been done, had a trust been made, because there was no will, there's no trust, there was nothing. The only thing that was done is, again, in the late 80s, that deed was updated, and that was law. That was law for it. Again, for my friend, it was good for her, but for this gentleman's family, I can only imagine how they must feel. So that's one of the ones that I like to drill home the most, because again, it truly is the most overlooked, and you'd be surprised at some of the phone calls that I've had in regards to that. Any other questions?
I have another question. Nobody else does. You mentioned it's good to have an advisor.
Mhm.
But so I don't know who, exactly to pick, because it's like I have a 401k through my work.
Mhm.
And then I have my bank, right? So 401k through my work, I would have to I think I have to pay someone to advise me on that. And maybe they have a free virtual thing, which you can basically do.
Mhm.
But if I picked someone, let's say from my bank, would I show them, my 401k and say, oh, this is how I'm investing this. And then they would see all the details, or how does that work? Or I'm just telling them what to do, and then they how do they do that?
Yeah, I mean, there are a couple of different options. I'm sorry, go ahead.
And obviously, the bank has nothing to do with this 401k. So I don't know what to do.
Yeah, well, there's a couple of different ways that you can approach that. Typically, most 401k providers, now you may not have the ability to sit down with someone in person, but most of them do have virtual help desks or virtual appointments that you can schedule. And essentially what that individual will be able to do is walk through that specification that you've set up and provide that guidance. Now, typically on a 401k, you're not going to get advice, to your point, unless you paid for it, but you will get a good education and be given some good details on how you can make those selections for yourself best. From a bank side, I mean, it would be to the bank's benefit to walk through that with you, because when you retire, there'll be dollars that could potentially be rolled over to that account, and they would have the ability to help govern those dollars a bit for you more efficiently once you reach retirement. But I haven't found that most banks will turn people away if you're working with them, if you have outside accounts and you do want to get some advice on what those, how those dollars are invested. And primarily because, again, we want to make sure that you're diversified. A lot of people think that diversification means I've got an account here, here, and here. And that's typically not the case. Typically, you've got the same type of investments that the investments may mirror, but they're not diversified because they're at different locations. So typically your bank representatives, especially those that specialize in the investment world, will want to help. They'll want to help you take a look at that to ensure that those dollars are working for you most efficiently.
So it sounds like it would be okay.
Definitely. That's where I'd start. I'd start there. Yes.
Because I suppose I would go to do that and go through a virtual, advisor through 401k.
Yeah. Yeah.
This would be a potential person I could go back to and see in person.
And check your plan provider. Various plan providers, the record keeper of your 401k, or who you get your statements from, some of them do have local representatives, but the lion's share will be virtual. But it doesn't hurt to check. It doesn't hurt to check to see if there is someone local that could have that conversation with you.
Just because, it's like there are all these different things, so it would be easier to go to someone to see all of them. So that would be okay to go through.
Yeah, I would definitely recommend starting with your bank and going out from there.
Because I have that, I don't know what to invest in, so I just selected 2030 retirement age. Was it Hero?
Yep.
So is that sounds? I thought that was fairly diversified.
Those are diversified portfolios. Anything that's a 2030, it's a mutual fund that has a wide variety of investments in there geared towards that 2030 retirement date. But if it's a 2030 and it's passive, like we talked about, it's not looking to time the market necessarily. It's just looking to mirror the market. So sometimes if you sit down with an individual, they can help maybe tailor a product more for you if you are looking for something that's more active. So your target date fund is typically going to be a passive investment where it's a packaged product, it's diversified, but no one is looking to time the market in that type of product. It creates a portfolio tracking towards that retirement date. And it's not as technical as an actively managed portfolio might be.
That's the only element I can do about. So.
Yeah, again, a perfect reason for you to schedule that conversation.
So the ones that, like she was just talking about, those are the passive.
If it's just the 2035, they're typically going to be passive. Target date funds in by nature are typically passive investment. That doesn't make them bad. They're just not as actively managed. Someone isn't trading in and out of them and making decisions based on technical analysis, meaning they're not looking at them in the same way. They're more or less mirroring what the overall stock market does and saying that they know in 2030 she's retiring. So we want to have this much cash. And by cash, I mean cash equivalents that's not getting a lot of risk. We want to have this much and this many investments that are international. They're exposed to more risk. This many investments that are going to be a bit more conservative and US based. So they're diversified, but they're not as actively managed as some of the other investment vehicles.
Like we can't, because like that's, like mine is like that through work.
Mhm.
We can't, how do we make that into an active?
Well, it would depend on how your portfolio is set up. So you would want to check with your plan provider to determine if that's something that they offer. If not, they typically offer inside of that retirement plan other investment opportunities. So you'll have mutual funds and bond funds that you can select from, and you build that active portfolio.
So how do we get the education to be able to look at that and know how we do that?
Again, that's where I would say you want to lean heavily on your employer. Most employer-sponsored plans, most retirement plans, so your company is offering the benefit to you, but they don't necessarily provide the vehicle that you're investing in. But if you go back to the provider, typically the provider has resources for you. So, for example, if it was Old National, and Old National was offering the plan, let's say you worked at the Children's Museum, and Old National has a 401k, a 403b, they're nonprofit, a 403b for the Children's Museum. We want to be here helping educate their staff to ensure that those dollars are meeting the investors' goals. So again, I would heavily lean on your employer and ask for, make sure they have a good connection with their provider, because most providers do provide some level of education and some level of assistance for individuals to make those decisions.
Okay, so a little bit off of that. So like, I have an emergency fund
Mhm,
and it's sitting in a savings account.
mhm,
And it's not earning any interest or growing on,
mhm,
but where I still have access to it if I need it for an emergency.
mhm.
Where would I look to put that so it can grow some? I know it's not gonna grow as if I invested it or anything, but to where it can still grow a little better than it does just sitting in my savings.
Yeah, so for an emergency fund, our recommendation would be that it probably doesn't, simply because unless you find another bank that has a money market fund that's paying a little something, right now they're not. But the recommendation would be not to do that, because again, liquidity. If you have an emergency, you need to be able to get access to that money. And anything that's going to give you a little bit more is going to require a little bit more too. So we wouldn't want that money. Again, it's not that you can't afford to lose that emergency fund. We just don't want to put that in jeopardy. We want to keep that safe, because, if something goes, I don't even know, the alternator on the car, we know that's $400 or $500 expense that we need to be able to get to right away to fix that situation. So we're not out of work and the kids aren't out of school or whatever would impede, your day. I think you had a question?
Yeah, I had a question about kind of piggybacking on what she said. I was thinking, I heard you mentioned something about like investment as income driven, and I know it's not like immediate, but I guess I'm thinking more of like maybe a short-term savings, so like a regular like emergency savings account is like something that I have too,
Mhm.
and then I have retirement with my company, which is a long-term savings account. Is there something like in the center, like a short term that I can maybe invest in for like maybe a couple years or
Sure.
5 years to gain income? Like, how does that work?
Yeah, so there are, most of us, is anybody familiar with Cash App? Everybody, right? So with Cash App, you can make a brokerage account using your Cash App account now, and you can invest in any type of stocks that you want to. Now, without doing a risk analysis and understanding your specific goals, we can't say, well, invest in this, because I don't know what that time horizon looks like for you or what your goal is. But there are a wide variety of vehicles for short term, for more short term, and it would just be a traditional brokerage account, similar to a checking account, but it's with a brokerage firm or a firm like Cash App now, giving you the ability to make purchases in individual stocks. Again, and you can do it with $5. You can do it with whatever amount you want to use, just to play with it until you get comfortable.
So like you were mentioning, you just mentioned Apple, and I'm just using Apple just because.
Uh-huh.
So say Apple costs $20 to buy a piece of stock.
Uh-huh.
Or another know that's probably low for Apple or something like that, but you would have to have that much. So say if Apple was $2,000 for a stock, you would have to have $2,000 to purchase one.
No, you can purchase fractional shares. And that's the nice thing about some of these apps that allow you to buy in. If you pull up your Cash App, I'm not sure which page it's on, but it'll show you that give you the option. And if you wanted to buy $5 worth of Apple, you'd buy $5 worth of Apple. Now that might be 0.0005 shares of Apple, so a little bitty piece, but you're still an owner. And it's going to grow. And the more you continue to make those contributions in, obviously, the more beneficial that's going to be for you in the long haul. And so when you think about organizations that you're already doing business with, did you find she found it? Mm-hmm. Yeah. So that's kind of the intermediate, but again, risk. Think about your risk tolerance before you make those selections.
We don't have any in the chat, so that was good. And if families have questions, either from watching their recording or like if this group thinks of questions later, is it okay if they reach out to you?
Definitely. And I'll provide you my contact
Perfect,
information. I think
yeah.
you already have my contact information,
do,
so please feel free.
Yeah.
Please feel free. We're happy at Old National Bank to answer any additional questions that you have. We've got great products and services as well. So if you guys do have any additional questions, feel free to reach out. I hope that this was helpful. I know it's a lot of information, and sometimes we can probably go a little bit slower on one topic. So happy to come back. We're happy to answer any additional questions that you guys have. I definitely enjoyed spending time with you ladies tonight.
Thank you so much for joining us tonight. I'm going to turn the Zoom off. And the webinar.